Section 1.1 to 1.3 Capital Gains. 1.1 Definition and Significance. Capital gains refer to the profit earned from the sale of a capital asset, such as stocks, bonds, real estate, or other investments. It represents the difference between the purchase price, or the cost basis, of the asset and the selling price. If the selling price is higher than the purchase price, the investor realizes a capital gain. Conversely, if the selling price is lower than the purchase price, it results in a capital loss. Capital gains play a crucial role in investment performance for several reasons. Profit generation. Capital gains provide a means for investors to generate profits by buying assets at a lower price and selling them at a higher price. Investors can create wealth and grow their investment portfolios. Total return. Capital gains contribute to the total return on an investment. Total return is the sum of capital gains and any income generated by the investment, such as dividends, interest, or rental income. Including capital gains in the calculation of total return provides a more comprehensive measure of investment performance. Long-term growth. Capital gains are particularly important for long-term investment growth. By reinvesting capital gains, investors can compound their returns over time, potentially accelerating the growth of their investment portfolio. Tax implications. Capital gains have tax implications, and understanding them is crucial for investors. In many countries, capital gains are subject to taxation, either at a lower rate than regular income or with certain tax advantages for long-term investments. Properly managing capital gains can help minimize tax liabilities and enhance after-tax returns. Portfolio diversification. Capital gains can help diversify an investment portfolio. By investing in a range of assets with varying growth potential, investors can reduce their overall risk exposure. Capital gains from one investment may offset losses in another, leading to a more balanced portfolio. Market performance. Capital gains are influenced by the performance of financial markets. Positive market trends and economic growth can drive up the prices of assets, resulting in capital gains for investors. Monitoring and understanding market conditions is essential for maximizing capital gains. It's important to note that capital gains are not realized until an asset is sold. Therefore, investors have control over when and how they realize their gains, allowing them to strategically manage their investment positions. Capital gains, yield, and total return are different investment metrics that provide insights into various aspects of an investment's performance. Here's how they differ. Capital gains. Capital gains specifically refer to the profit earned from the sale of an investment asset. It represents the difference between the purchase price and the selling price of the asset. Capital gains are realized only when the asset is sold, and they reflect the appreciation in the asset's value over time. Capital gains are not influenced by income generated from the investment, such as dividends or interest. Yield. Yield is a measure of the income generated by an investment relative to its cost or market value. It is usually expressed as a percentage. Yield can refer to different types of income, depending on the investment. For example, in stocks, yield often refers to dividend yield, which is the annual dividend income as a percentage of the stock's current price. In bonds, yield typically refers to the yield to maturity, which takes into account both the coupon payments and the capital gain or loss if the bond is held until maturity. Total return. Total return is a comprehensive measure that considers both the capital appreciation and the income generated by an investment over a specific period. It takes into account not only capital gains but also dividends, interest, or any other distributions received from the investment. Total return is expressed as a percentage and provides a holistic view of an investment's performance. It is often used to evaluate the overall effectiveness of an investment strategy. In summary, while capital gains focus specifically on the increase in an investment's value upon sale, yield examines the income generated by an investment relative to its cost or market value. Total return encompasses both capital gains and income, providing a comprehensive measure of an investment's overall performance. Each of these metrics offers unique insights into different aspects of investment performance, and investors may consider all of them when assessing their investment portfolios. Capital gains can have a significant impact on wealth accumulation for investors. Here are some ways in which capital gains contribute to wealth accumulation. Investment growth. capital gains are a result of the appreciation in the value of investment assets over time. By buying assets at a lower price and selling them at a higher price, investors realize capital gains that increase the value of their investment portfolios. These gains, when reinvested, can compound over time and significantly contribute to wealth accumulation. Compounding returns. Reinvesting capital gains allows for compounding returns. Compounding occurs when the returns generated from an investment are reinvested and generate additional returns. Over the long term, compounding can have a substantial impact on wealth accumulation. By continually reinvesting capital gains, investors can benefit from the compounding effect and potentially accelerate the growth of their investment portfolios. Diversification and risk management. Capital gains from different investments can help diversify an investment portfolio. By holding a diversified portfolio, investors can spread their risk across various asset classes and potentially reduce the impact of market volatility. Capital gains from one investment can offset potential losses from others, providing stability and contributing to wealth accumulation over time. Tax efficiency. Proper management of capital gains can enhance tax efficiency, which can have a positive impact on wealth accumulation. Depending on the tax laws of a particular jurisdiction, capital gains may be subject to favorable tax treatment, such as lower tax rates or tax deferrals for long-term investments. By strategically realizing capital gains in a tax-efficient manner, investors can minimize their tax liabilities and maximize after-tax returns, leading to greater wealth accumulation. Long-term investment strategies. Capital gains are particularly relevant for long-term investment strategies. By adopting a long-term perspective, investors can ride out short-term market fluctuations and capture the potential for capital gains over an extended period. Long-term investments provide more time for compounding to work its magic and allow investors to benefit from the growth potential of different assets, leading to greater wealth accumulation. It's important to note that capital gains are influenced by various factors, including market conditions, investment selection, and the investor's ability to time the market effectively. Investment performance is never guaranteed, and investors should carefully consider their risk tolerance, goals, and investment time horizon when seeking to accumulate wealth through capital gains. 1.2 Types of capital gains. Short-term capital gains and long-term capital gains are two categories of capital gains that are differentiated based on the holding period of an investment. Here's how they are defined. Short-term capital gains. Short-term capital gains are the profits realized from the sale of an investment asset that has been held for 1 year or less. In most jurisdictions, including the United States, the holding period for an investment to be considered short-term is 12 months or less. Short-term capital gains are typically subject to higher tax rates than long-term capital gains, as they are often taxed at the investor's ordinary income tax rate. Long-term capital gains. Long-term capital gains, on the other hand, are the profits realized from the sale of an investment asset that has been held for more than 1 year. The specific holding period required to qualify for long-term capital gains may vary between jurisdictions. In the United States, for example, an investment held for more than 1 year is considered long-term. Long-term capital gains are often subject to preferential tax rates, which are typically lower than ordinary income tax rates. This tax advantage is designed to incentivize long-term investment holding and reward investors for their patience and commitment. The differentiation between short-term and long-term capital gains has significant tax implications. By holding investments for the long term, investors may benefit from lower tax rates on their capital gains. This tax advantage can enhance after-tax returns and contribute to wealth accumulation. It's important for investors to consider the tax implications of their investment strategies and to consult with tax professionals to fully understand the specific rules and rates governing short-term and long-term capital gains in their respective jurisdictions. The distinction between short-term and long-term capital gains lies in the holding period of an investment, and the tax treatments for each category differ. Here's a closer look at the differences in tax treatment. Short-term capital gains tax treatment. Holding period. Short-term capital gains are realized from the sale of an investment held for 1 year or less. Tax rates. Short-term capital gains are typically taxed at the investor's ordinary income tax rates, which are the same rates applied to their regular income. Tax impact. Since ordinary income tax rates are often higher than long-term capital gains tax rates, the tax liability on short-term capital gains can be relatively higher. The exact tax rates depend on the investor's income bracket and applicable tax laws in their jurisdiction. Long-term capital gains tax treatment. Holding period. Long-term capital gains are realized from the sale of an investment held for more than 1 year. The specific holding period required to qualify for long-term capital gains may vary between jurisdictions. Tax rates. Long-term capital gains typically receive preferential tax treatment, meaning they are subject to lower tax rates compared to ordinary income tax rates. Tax impact. The tax rates for long-term capital gains are generally lower than those for short-term capital gains. The specific long-term capital gains tax rates depend on the investor's income level and the applicable tax laws in their jurisdiction. It's important to note that tax laws can vary significantly between countries, and the specific rates and rules may change over time. Therefore, it's essential for investors to consult with tax professionals or refer to the tax regulations in their jurisdiction to understand the exact tax treatment of short-term and long-term capital gains. Proper tax planning and understanding the tax implications of different holding periods can help investors optimize their after-tax returns and effectively manage their investment strategies. Several types of assets have the potential to generate capital gains. Here are some common examples. Stocks. Stocks or shares of publicly traded companies are among the most well-known assets that can generate capital gains. If an investor purchases stocks at a lower price and sells them at a higher price, they can realize capital gains. The stock market's performance and the individual company's success or failure can significantly influence the capital gains generated from stocks. Bonds. Bonds are debt instruments issued by governments, municipalities, and corporations. While bonds primarily generate income through periodic interest payments, they can also generate capital gains if their market value increases. Investors who buy bonds at a lower price and sell them when their market value rises can realize capital gains. Real estate. Real estate investments, such as residential or commercial properties, can generate capital gains when sold at a higher price than the purchase price. The appreciation in property values over time, driven by factors like market demand, location, and improvements made to the property, can lead to capital gains. Mutual funds and exchange-traded funds, ETFs. Mutual funds and ETFs are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets. When the underlying assets within these funds increase in value, investors can realize capital gains when selling their shares in the fund. Commodities. Commodities, such as precious metals, gold, silver, energy resources, oil, natural gas, agricultural products, and others, can generate capital gains. The prices of commodities fluctuate based on supply and demand dynamics, global economic conditions, and geopolitical factors, which can create opportunities for capital gains. Cryptocurrencies. Cryptocurrencies, such as Bitcoin, Ethereum, and others, have gained popularity in recent years. Investors who buy cryptocurrencies and sell them at a higher price can realize capital gains. However, it's important to note that the cryptocurrency market can be highly volatile and speculative. Art and collectibles. Investments in art, collectibles, and other valuable items can generate capital gains if their value appreciates over time. This category includes items like fine art, antique furniture, vintage cars, rare stamps, and more. The capital gains realized depend on factors like market demand, rarity, condition, and the overall popularity of the item. These are just a few examples of assets that can generate capital gains. It's important to research and understand the specific characteristics, risks, and potential returns associated with each asset class before investing. Several types of assets have the potential to generate capital gains. Here are some common examples. Stocks. Shares of publicly traded companies can generate capital gains if their market value increases. Investors can realize capital gains by selling stocks at a higher price than their purchase price. Capital gains from stocks can result from price appreciation, stock splits, or dividends. Bonds. Bonds are debt instruments issued by governments, municipalities, and corporations. While bonds primarily generate income through periodic interest payments, they can also generate capital gains if their market value rises above the purchase price. This can occur when interest rates decline or when the bond's creditworthiness improves. Real estate. real estate investments, such as residential or commercial properties, can generate capital gains when sold at a higher price than the purchase price. The appreciation in property values over time, driven by factors like market demand, location, and improvements made to the property, can lead to capital gains. Mutual funds and exchange-traded funds, ETFs. Mutual funds and ETFs are investment vehicles that pool money from multiple investors to invest in a diversified portfolio of assets. When the underlying assets within these funds increase in value, the fund's shares can generate capital gains when sold at a higher price. Commodities, such as precious metals, gold, silver, energy resources, oil, natural gas, agricultural products, and others, can generate capital gains. The prices of commodities fluctuate based on supply and demand dynamics, global economic conditions, and geopolitical factors, creating opportunities for capital gains. Cryptocurrencies, such as Bitcoin, Ethereum, and others, have gained popularity in recent years. Investors who buy cryptocurrencies and sell them at a higher price can realize capital gains. However, it's important to note that the cryptocurrency market can be highly volatile and speculative. Art and collectibles, investments in art, collectibles, and other valuable items can generate capital gains if their value appreciates over time. This category includes items like fine art, antique furniture, vintage cars, rare stamps, and more. The capital gains realized depend on factors like market demand, rarity, condition, and the overall popularity of the item. These are just a few examples of assets that can generate capital gains. It's important to research and understand the specific characteristics, risks, and potential returns associated with each asset class before investing. Additionally, tax implications may vary depending on the asset and the investor's jurisdiction. Consulting with a financial advisor or tax professional is recommended. 1.3 Capital gains versus capital losses. Capital losses are the opposite of capital gains and occur when the selling price of an investment asset is lower than its purchase price. In other words, it represents a loss on the investment. Capital losses can have several impacts on investment returns, offsetting capital gains. Capital losses can be used to offset capital gains, reducing the overall tax liability on investment returns. In many jurisdictions, capital losses can be used to offset capital gains in the same tax year or carried forward to future years to offset future gains. By strategically harvesting capital losses, investors can minimize their tax obligations and improve after-tax returns. Net losses and tax deductions. If capital losses exceed capital gains in a given tax year, the investor may have a net capital loss. Net capital losses can sometimes be used to offset other types of income, such as salary or business income, resulting in tax deductions. The availability and rules regarding the deduction of net capital losses vary by jurisdiction, so it's essential to consult with a tax professional for specific guidance. Adjusting portfolio strategy. Capital losses can prompt investors to reassess their investment strategy and make necessary adjustments. Losses can provide valuable feedback on the performance of specific investments, asset classes, or overall portfolio allocation. By analyzing the reasons behind the losses, investors can learn from their mistakes and make more informed investment decisions going forward. Long-term investment perspective. Capital losses are an inherent part of investing, especially in volatile markets. It's crucial to keep a long-term perspective and not let short-term losses derail the investment strategy. By staying focused on long-term goals, investors can ride out market downturns and potentially recover from losses over time. Maintaining discipline and avoiding panic selling is key to achieving long-term investment success. Loss carryforward. In some jurisdictions, unused capital losses can be carried forward to future years. This means that if an investor has capital losses in one year that cannot be fully offset by capital gains, the remaining losses can be carried forward and used to offset future capital gains. This can help mitigate the impact of losses on overall investment returns over the long term. It's important to note that capital losses are not desirable in and of themselves, as they represent a decline in the value of an investment. However, understanding the impact of capital losses and utilizing strategies to manage them effectively can help investors minimize their tax burden and make more informed investment decisions. The interaction between capital gains and capital losses for tax purposes is important to understand as it can have significant implications on an investor's tax liability. Here are some key aspects to consider. Capital losses offset capital gains. Capital losses can be used to offset capital gains for tax purposes. If an investor realizes a capital loss on one investment, they can use that loss to offset any capital gains realized on other investments within the same tax year. This offsetting mechanism is known as tax loss harvesting. By offsetting capital gains with capital losses, investors can reduce their taxable income and lower their overall tax liability. Net capital gains or losses, if an investor's capital losses exceed their capital gains in a tax year, they may have a net capital loss. Net capital losses can be used to offset other types of income, such as salary or business income, to reduce the overall tax liability. However, the rules regarding the deduction of net capital losses vary by jurisdiction, and there may be limitations on the amount of net capital losses that can be deducted in a given year. Carryforward or carryback of capital losses. In some jurisdictions, if an investor has unused capital losses after offsetting against capital gains, they can carry forward those losses to future tax years. This means that the losses can be used to offset future capital gains and potentially reduce tax liabilities in the future. Alternatively, in certain jurisdictions, capital losses can be carried back to offset gains from previous years and potentially obtain a refund for taxes paid in those years. The specific rules for carrying forward or carrying back capital losses vary by jurisdiction, so it's important to consult with a tax professional or refer to the tax regulations in the specific jurisdiction. Time limit for loss carryforward. In jurisdictions that allow the carryforward of capital losses, there is often a time limit within which the losses must be utilized. For example, losses may need to be utilized within a certain number of years, after which they may expire. It's important for investors to be aware of these time limits to effectively utilize their capital losses for tax planning purposes. Wash sale rules. Some jurisdictions have wash sale rules that limit the ability to claim a capital loss if substantially identical securities are repurchased within a certain time frame. These rules are designed to prevent investors from artificially realizing losses for tax purposes while maintaining their exposure to the same investment. Wash sale rules can impact the timing and eligibility of claiming capital losses, so it's important to understand and comply with these rules. It's crucial to consult with a tax professional or refer to the tax regulations in the specific jurisdiction to fully understand the interaction between capital gains and capital losses for tax purposes. They can provide personalized guidance based on individual circumstances and help optimize tax planning strategies. Tax-efficient investing strategies are essential for maximizing after-tax returns and preserving wealth. Here are some reasons why tax-efficient investing is important. Minimizing tax liability. By employing tax-efficient investment strategies, investors can minimize their tax liability. By managing capital gains and losses, utilizing tax-advantaged accounts, and employing strategies like tax loss harvesting, investors can reduce the amount of taxes they owe on their investment returns. This can have a significant impact on overall portfolio performance and wealth accumulation. Maximizing after-tax returns. Taxes can erode a significant portion of investment returns. By focusing on tax efficiency, investors can maximize their after-tax returns. This means that more of the investment gains can be retained and reinvested, compounding growth over time. Minimizing tax drag allows investors to benefit from the power of compounding and potentially achieve higher long-term wealth accumulation. Asset location optimization. Tax-efficient investing involves strategically locating investments in different types of accounts to minimize tax implications. For example, placing tax-efficient investments, like index funds or tax-efficient ETFs, in taxable accounts and tax-inefficient investments, like actively managed funds, in tax-advantaged accounts can help reduce the tax burden. By aligning the investment type with the most appropriate account, investors can optimize their tax efficiency and enhance overall portfolio performance. Managing tax consequences of rebalancing. Regular portfolio rebalancing is an important aspect of investment management. However, it can trigger taxable events, such as capital gains. Tax-efficient investing strategies consider the tax consequences of rebalancing and aim to minimize the impact. This can be achieved by focusing on tax-efficient asset classes, using tax loss harvesting techniques, or employing tax-managed funds, estate planning and wealth preservation. Tax-efficient investing is also crucial for estate planning and wealth preservation. By utilizing tax-efficient strategies, investors can minimize estate taxes, gift taxes, and other tax implications when transferring wealth to future generations. This can help ensure that more of the wealth is preserved and passed on to beneficiaries, rather than being eroded by taxes. Long-term financial planning. Tax-efficient investing should be integrated into long-term financial planning. By considering the tax implications of various investment decisions, investors can align their investment strategies with their overall financial goals. This includes optimizing retirement savings, managing required minimum distributions, RMDs, and taking advantage of tax-advantaged accounts and investment vehicles. It's important to note that tax laws and regulations can vary between jurisdictions and may change over time. Therefore, working with a qualified tax professional or financial advisor is crucial to develop and implement effective tax-efficient investing strategies tailored to individual circumstances. They can provide personalized advice and guidance based on specific goals, tax considerations, and applicable laws.